You work hard all year long, and your wealth grows by 10 to 15%. They grow billions in a year while they sleep. The question is not that they are smarter. The question is, what game are they playing that you were never taught? There was a time when you and them were on the same line, a startup, an idea, starting from zero. Today you are looking at a savings account, and he owns the most expensive company in the world. It's not luck, it's not hard work either. It's a system. Today I will show you the same 6 mechanisms that billionaires use to grow their wealth hundreds of times faster than you. Stay until the end, because the last point is the one that most people can't stand. The software engineer in Austin makes $180,000 per year. That's $493 per day. He's talented, educated, works hard. He goes to sleep having earned $493 for his full day of work. Jeff Bezos made $2 billion that same day because Amazon stock moved up 0.87%. He owns 9.5% of Amazon, 988 million shares. His wealth increased by $2 billion while he slept. The engineer traded time for money. Bezos owns an asset that appreciates. That's the first mechanism, and it's been working for 150 years. 1882, John D. Rockefeller becomes the richest man in America. His wealth peaks at $400 billion in today's dollars. He built Standard Oil from nothing to controlling 90% of American oil refining in just 20 years. Rockefeller didn't pump oil. He owned the system, the refineries, the pipelines, the distribution networks. When America consumed oil, Rockefeller got paid while he slept. Jump forward to 1913. Henry Ford revolutionizes manufacturing with the assembly line. Ford's wealth explodes from $1 million to about $200 billion in today's dollars in just 8 years. Ford didn't assemble cars with his own hands. He owned the factory, the process, the equity. When the factory produced cars, Ford got paid while he slept. The pattern is clear. But let's go deeper into the mathematics. Take 2 people. Person A is a high-earning professional making $500,000 per year. Over 40 years, they earn $20 million gross. After taxes and expenses, they retire with $5 million. Person B starts a company, pays themselves $80,000 per year, but they own 100% of the equity. After 10 years, it's worth $50 million. After 20 years, the company goes public at $500 million. Person B owns 60% after dilution. That's $300 million in net worth. Person B earned less salary every single year, but built 60 times more wealth. The difference is the mechanism. Person A traded time for money linearly. Person B built equity that appreciated exponentially. When you work a job, you trade your time for money. You work 1 hour. You get paid for 1 hour. Your income is linear. It scales with your time. And time is finite. Even if you could work all 24 hours, you'd hit a ceiling. But when you own an asset, the asset generates value independent of your time. A rental property generates rent, whether you're working or sleeping. A business generates profit, whether you're in the office or on vacation. A stock portfolio appreciates whether you're awake or asleep. Wage earners sell time. Billionaires own assets, and assets scale infinitely. Let's look at historical proof across every era. Cornelius Vanderbilt died in 1877 with $240 billion in today's dollars. He built wealth by owning transportation infrastructure, steamships, then railroads. At his peak, Vanderbilt controlled the New York Central Railroad. Every person moving through New York paid Vanderbilt. Andrew Carnegie died in 1919 with $380 billion. Carnegie Steel produced 25% of America's steel. When America built railroads, bridges, skyscrapers, Carnegie got paid. John D. Rockefeller died in 1937 with $400 billion. Standard Oil controlled 90% of American oil refining. When America consumed oil, Rockefeller got paid. Henry Ford died in 1947 with $200 billion. By 1920, Ford produced 50% of all cars in America. When Americans bought cars, Ford got paid. None earned their wealth through salaries. All owned assets that generated value at scale. Now fast forward to the modern era. The assets changed, the principle didn't. Bill Gates. Net worth $139 billion. Gates got rich by owning Microsoft stock. Microsoft's market cap is $3.2 trillion. Gates owns 1.3%. When Microsoft sells software and cloud services, Gates gets paid through stock appreciation. Warren Buffett. Net worth $120 billion. Buffett owns 38% of Berkshire Hathaway. Berkshire owns pieces of Apple, Coca-Cola, American Express. When these companies generate profit, Berkshire's stock rises. Jeff Bezos. Net worth $230 billion. Bezos owns 9.5% of Amazon. In 2023, Bezos' net worth grew by $70 billion. He didn't work $70 billion worth of hours. The Amazon stock appreciated. Elon Musk. Net worth $250 billion. Musk owns 13% of Tesla and 42% of SpaceX. In 2021, Musk's net worth increased by $121 billion in 1 year. The pattern repeats across centuries. Billionaires own equity in systems that generate value at scale. But ownership is just the first mechanism. The second is leverage, using borrowed money to amplify returns. Here's how it works. You have $10 million. You want to buy an office building worth $50 million. You put down $10 million. Borrow $40 million at 5% interest. The building generates $4 million per year in rent. Your loan costs $2 million in interest. You keep $2 million in cash flow. The building appreciates 3% annually. That's $1.5 million. Your total return is $3.5 million per year on $10 million invested. That's a 35% annual return. Without leverage, a $10 million building generates $800,000 in rent and $300,000 in appreciation. Total $1.1 million and 11% return. Leverage multiplied your returns by 3.2 times. Sam Zell died in 2023 with $6 billion, built wealth through leveraged real estate. He bought undervalued properties with maximum leverage, improved them, and refinanced at higher valuations. Stephen Ross. Net worth $11 billion, built related companies using leverage constantly. Hudson Yards, a $25 billion project, was built with minimal equity and maximum debt. Every billionaire uses leverage. Rockefeller borrowed to buy competitors. Bezos raised capital to fund Amazon's growth. Musk borrowed against Tesla shares to fund SpaceX. But leverage is a multiplier. If your asset grows, leverage multiplies gains. If it shrinks, leverage multiplies losses. Billionaires borrow to buy appreciating assets. Regular people borrow on credit cards at 24% to fund consumption. That destroys wealth. The third mechanism is scale. Billionaires operate at scales that create exponential advantages. A local bakery buys flour at $50 per pound. A national chain buys flour at $20 per pound. The chain's cost is 60% lower. This allows undercutting on price while maintaining higher margins. This is economies of scale. Amazon, Walmart, Costco all built empires on scale advantages. But scale creates something more powerful. Network effects. A network effect exists when a product becomes more valuable as more people use it. Facebook with 1 user has no value. Facebook with 3 billion users is valuable because everyone is there. Microsoft built dominance on network effects. More Windows users meant more software developers, which attracted more users, which attracted more developers. A compounding loop. Visa and MasterCard built trillion-dollar payment networks on this principle. Each additional merchant and cardholder makes the network more valuable to everyone. The fourth mechanism is access to capital. Billionaires access capital at rates regular people cannot. When Bezos needs $10 billion, he calls Goldman Sachs. They arrange a loan secured by Amazon shares at 3% interest. When a regular person needs $10,000, they pay 12% or put it on a credit card at 24%. When Musk needs $50 billion, he raises it from private equity and sovereign wealth funds. When a small business needs $500,000, they struggle to get a bank loan at 8 to 10%. But there's a deeper mechanism. Billionaires access investments unavailable to regular people. Private equity, pre-IPO shares, exclusive hedge funds. Peter Thiel invested $500,000 in Facebook in 2004 for 10.2% of the company. When Facebook went public in 2012, Thiel's stake was worth $1 billion. That's a 2,000 times return. Regular people couldn't invest until the IPO, when Facebook was valued at $100 billion. This is information asymmetry. Billionaires know about opportunities earlier and invest at lower valuations. By the time regular people hear about them, the biggest gains are gone. Billionaires also structure finances to minimize taxes legally. They borrow against appreciating assets rather than selling them, avoiding capital gains taxes. Warren Buffett's effective tax rate is lower than his secretary's because his wealth comes from capital gains taxed at lower rates than ordinary income. The fifth mechanism is time horizon. Billionaires think in decades. Regular people think in months. When Bezos founded Amazon in 1994, he told investors it wouldn't be profitable for years. Amazon lost money for 7 years, but Bezos had patient capital. Amazon prioritized market share and infrastructure. Once built, profits followed. Amazon's net income in 2023 was $30 billion. Warren Buffett bought Coca-Cola stock in 1988 and still holds it today. 36 years later, his cost basis is $3.25 per share. Coca-Cola trades at $62 in December 2024. That's a 19 times return plus decades of dividends. This long-term orientation allows billionaires to ignore short-term volatility. Regular people panic when markets drop 20% and sell at a loss. Billionaires see drops as buying opportunities. The sixth mechanism is specialization. Billionaires concentrate wealth in areas where they have expertise and conviction. Warren Buffett built wealth through Berkshire Hathaway with concentrated positions in a few dozen companies. Elon Musk concentrates in Tesla and SpaceX. Bill Gates built wealth holding Microsoft stock. This concentration creates massive upside when correct. It creates downside risk. But billionaires accept that because they have conviction. Regular people diversify to reduce risk, but diversification limits upside. If you own 100 stocks and one goes up 10 times, your portfolio only goes up 10%. If a billionaire concentrates 50% in one investment that goes 10 times, their net worth grows 5 times. Now let's look at the mathematical difference between salary and equity. Person A earns $75,000 per year with 3% raises. Over 40 years, they earn $6.1 million gross. After taxes and expenses, they invest and retire with $4.2 million. Person B starts a company. By year 25, the company is acquired for $800 million. Person B owns 50%, netting $400 million. Person B has 95 times the net worth of Person A. Both worked hard. The difference is the mechanism. Real historical examples prove this. In 1975, Bill Gates founded Microsoft at age 20. If Gates had taken a job at IBM earning $30,000 with 5% raises for 40 years, he'd have earned $4.5 million gross, retiring with perhaps $5 million. Instead, Gates owned Microsoft equity. By the 1986 IPO, Gates owned 45%. His stake was worth $350 million at age 31. By 1999, Gates's net worth peaked at $101 billion. The difference between $5 million from salary and $101 billion from equity is 20,200 times. Jeff Bezos was earning $500,000 at D.E. Shaw in 1994. If he'd stayed until retirement in 2024, he'd have earned $40 million gross, netting perhaps $25 million. Instead, Bezos founded Amazon. By 2024, his net worth is $230 billion. The difference is 9,200 times. This is the pattern for every billionaire. They build equity in assets that appreciate exponentially. Now the compounding effect magnifies everything. A person with $1 million that does 7% doubles every 10 years. After 40 years, they have $16 million. A billionaire with $1 billion at 7% has $16 billion after 40 years. Same percentage return, but the absolute gain is 1,000 times larger. The billionaire made $15 billion. The millionaire made $15 million. This is exponential divergence. Compounding operates on a larger basis. A 10% return on $1 million is $100,000. On $1 billion is $100 million. Same percentage, 1,000 times difference. And billionaires access higher returns. Private equity targets 20% returns. Pre-IPO investments. Billionaires generate 10 to 15% annual returns, while regular people and index funds generate 7 to 8%. $1 million at 8% for 30 years becomes $10 million. $1 billion at 12% for 30 years becomes $30 billion. The billionaires' absolute gains were 3,000 times larger. This is why billionaires grow wealth faster. They own appreciating assets, use leverage to amplify returns, operate at scale, access capital and opportunities unavailable to others, maintain long-time horizons, and concentrate wealth in areas of expertise. So what does this mean for you? First, shift from earning income to owning assets. Your goal should be owning assets that appreciate independent of your time. Start a business where you own equity. Buy rental real estate. Buy dividend-paying stocks or index funds. Transition from selling time to owning things that generate value while you sleep. Second, understand leverage, but use it carefully. Borrowing to buy appreciating assets can multiply returns. Borrowing to fund consumption destroys wealth. The question is always, what am I borrowing for? If it's an appreciating asset, leverage can be powerful. If it's consumption, avoid debt. Third, think longer term. Billionaires hold assets for decades, buy quality assets, and hold through volatility. Compounding requires time. Fourth, concentrate in areas where you have knowledge, but do so intelligently. As you build knowledge in an industry, concentrating a portion of your wealth can generate higher returns. Only concentrate in things you actually understand. Fifth, continuously invest in learning. Billionaires have informational advantages because they learn about markets, businesses, and opportunities. You can narrow this gap through reading, studying industries, understanding financial statements. The more you know, the better your decisions. Sixth, focus on building equity, not income. Negotiate for stock options or equity, even if it means a lower salary. If you're an entrepreneur, prioritize building business value over drawing a high salary. Seventh, use time as an advantage. Start now, even if small. A person investing $500 per month from age 25 to 65 at 8% will have $1.4 million at retirement. Compounding happens because they started early and stayed consistent. Eighth, avoid lifestyle inflation. As income grows, resist proportionally increasing spending. The lesson isn't that you need to copy billionaire strategies. You don't have their access. The lesson is understanding the mechanisms and applying the principles at your scale. Ownership of appreciating assets beats salary. Leverage amplifies returns if used correctly. Scale creates compounding advantages. Long-time horizons allow compounding to work. Concentration in expertise generates higher returns. Starting early and staying consistent builds wealth. The billionaire path is closed to almost everyone, but the principles are available to everyone. You can't become Bezos by buying Amazon stock today, but you can build wealth by owning equity in appreciating assets over time. The difference between billionaires and everyone else isn't intelligence, work ethic, or luck. It's the mechanisms. They own equity. They use leverage. They operate at scale. They compound over decades. They concentrate in expertise. They think in systems that generate value independent of time. You can apply these principles starting today at your scale. Own assets that appreciate. Use leverage carefully. Think longer term. Build expertise and concentrate in areas you understand. Give compounding time to work. The mechanisms don't change. Only the scale changes. Understanding the mechanisms is the first step to using them. December 21st, 2024. Jeff Bezos made $2 billion in one day. A software engineer made 493. Now you know why. And now you know what to do about it. This is not financial advice. This is research data showing exactly how wealth is built at the highest levels and what principles you can apply. The system is visible now. What you do with that information is up to you.